Good day everyone, it's Tamer here. Today we're gonna talk about Tesla. Tesla stock has doubled in only 3 months. Shareholders who were patient with Tesla are really happy these days, but in investing it's all about the future, not the past. So right now we should ask, what now? Luckily for us, on the 29th it's gonna share its 4th quarter earnings report. And with the numbers being out, then we can know approximately what's gonna happen to the stock, or at least, is the rally that has been going with Tesla stock is justified. In today's video, we're gonna go through some important numbers and figures that you should look at if you are an investor in Tesla stock or a market participant who is just interested in investing. So enough talking, let's begin with the Wall Street expectations. Earnings per share are expected to decline 16% and reach $1.62 per share. Since the company has been losing money, we can't calculate trailing 12-month PE ratio, which is the best way to calculate a PE ratio for a company. Trailing PE ratio means that you take the current stock price and you divide it by the 12-month trailing earnings per share. And since Tesla has some unprofitable quarters, there's no earnings per share to calculate with the trailing PE ratio. In order to make this video interesting, let's run some scenarios. First of all, let's make some assumptions. Let's assume that the company will turn profitable for the next 3 quarters. And in every quarter, on each quarter, the company will earn $2 per share. We're talking about Tesla. We're talking about Tesla that earns $2 per share for the next 3 quarters every quarter. We can also assume that there will be no more shares added to the market. And in order to get to the PE ratio, we can also say that the stock price will not move higher or lower. We're going to say that the stock price is going to be around $560 per share. With all of those assumptions and Tesla being really profitable, still the PE ratio will be somewhere around 70. According to that metric, that makes Tesla really overpriced. Before you come and say you're a bear who doesn't like Tesla, you have a short position, I have no position whatsoever in Tesla, whether it's long or short position. And by the way, I'm a big fan of Tesla and Elon Musk, and I wish you, if you are a shareholder of Tesla, all the best. With that positive tone, smash the like button please. Now let's talk about revenues. Revenues are expected to decline 2.5%, reaching $7.05 billion. When it comes to growth stocks or companies, this figure is really important because you need a company to be able to grow massively. In Wall Street, market participants are looking for a high growing company in terms of revenues, and the profits, they leave it as a solvable issue for later or for the future. Usually this complacent mindset takes place when the economy is doing really good. Once the economy starts deteriorating, profitability will be the first thing that Wall Street will be looking at. In terms of revenue growth, Tesla is growing its revenue in a really high rate. Tesla has almost doubled its revenue between the years 2017 to 2018, from $11.75 billion to $21 billion for 2018. Now let's talk about key figures to look at. Tesla is growing its cash position. In the last quarter, Tesla enjoyed a positive cash flow of $371 million, which made its cash position reach $5.3 billion. Since Tesla burns a lot of cash, market participants or Tesla shareholders should see how much the company have added cash or burned cash during the quarter. The next thing to look at is the gross margins. Gross margin means net sales minus cost of goods sold, and this figure you divide by the net sales or the revenues. Higher gross margins mean that the company has more money to pay for other costs such as debt. Looking at quarterly data, back in the 2nd quarter of 2018, Tesla gross margins started deteriorating, falling down from 22% until it reached 12.46% in the 1st quarter of 2019. Since then, the gross margins started climbing back for Tesla, reaching 18.90% for the 3rd quarter of 2019. With the recent rally, Wall Street would definitely want to see a higher gross margins for Tesla. Shanghai Factory production rates. The factory went online ahead of time in late 2019. Market participants right now should take a look at the numbers and see actually how Tesla is handling the production rates and the production itself in China. To answer why this factory is important, it costs Tesla 67% less to produce a Model S car in China rather than producing it in the US. So if production picks up over there and delivery is gonna be going out sooner as expected, this will also be a tailwind for Tesla. And now you can ask why Model 3 is so important. If we take a look at the delivery numbers, in the third quarter of 2019, Tesla has delivered 79,700 Model 3 cars, while it delivered 17,000 Model S and the X cars combined. And the last thing is guidance for deliveries. At the end, it all comes to this figure. If a company like Tesla cannot show that it's growing its deliveries and sales, then it might be in a big problem. Yet with Tesla growing its sales and deliveries, it hasn't been a problem, as we saw before, at least until right now. And that's because there were no competition. And if there will be competition, I think Tesla will do good because it has a really good start from other companies. So by this we'll end this video. I hope that Tesla will do good and post good earnings report. Even if Tesla do report good earnings, some of the things might be already baked into the stock price, but it will be really interesting to see how the company really operated. So this is it for today. Thank you for watching. Follow me on Instagram and click the like button and have a great day.